IRA or simple IRA for my business. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. On today's podcast, going to be discussing whether you should do a SEP IRA or a simple IRA for your business. Now, just to preface what this podcast is going to cover, just for the record, I believe the Solo K is a far superior retirement plan than the SEP or a simple IRA if you are self-employed, meaning you have a business with no full-time employees other than the owners or their spouses, okay? But if you have a small business with one or few employees and you're deciding between a SEP, simple, and maybe a 401k, today's podcast is going to focus on the SEP and the simple IRA. So the SEP IRA is probably the most popular, pre-2001, the most popular employer IRA plan. Okay, between the SEP and the simple, the SEP IRA is still more popular, but pre-2001, pre-extra, the Economic Growth, Tax Relief, and Reconciliation Act, the SEP IRA was far more popular than the Solo K. Why? They both were pure profit-sharing plans. What's a profit-sharing plan? Meaning, if you are self-employed or you have a single member LLC, you can put away 20% of your net Schedule C up to a maximum amount, which in 2022 is $61,000, and that is going to go up to $66,000 in 2023. So it's pretty simple. If you're going to do 20% for you, if you have any other eligible employees, you have to do 20% of their salary as well. If you have a corporation, C Corp, S Corp, or a partnership, it's 25% of your W-2 or your guaranteed payment. So if you have 5 employees in your little business and you want to do a 10% employer contribution and everyone makes 50K, it's 10% of 50K across the board, okay, for all eligible employees. And I'll get into who is eligible in a moment. So it's a pure profit sharing plan. Unlike a Solo K today, whereas the employee deferral, which is $20,500 dollar for dollar, or $27,000 if you're over 50, plus the 20 or 25%. So a Solo K has both buckets. It has the employee deferral plus the employer profit sharing. In the SEP world, it's just an employer. So here's a simple example to really understand why the Solo K has surpassed the SEP IRA as the most popular plan for the self-employed. If one makes $40,000 sole proprietor and wants to max out under 50, Solo K will allow them to do $20,500 plus 20% of 40, giving them about $28,500, whereas a SEP would only give them 20% of 40 or 8,000. So, almost 3.5 times more in a solo. Now, when I mentioned that 20 or 25% profit sharing, that's a max. You can do 1% or 5% or 8% or 13, whatever you want. You just cannot go above the 20 or 25%. Now, the solo plan, again, is for a small business with no full-time employees. It's 1,000 hours or 3 consecutive years of 500 hours, other than the owners or their spouses. SEP IRA could be for a sole proprietor or a company with 10, 5, 3 employees. Now, who's eligible for a SEP? So any employee over 21 and someone who's made at least $750, okay? And this is the kicker, which a lot of people don't comprehend and don't even know this element exists. It's called the 3 out of 5 rule, meaning only eligible employees that have worked 3 out of the last 5 years are eligible. So if you have a new business and you hired 4 people, you don't have to offer them SEP benefits until they've worked 3 out of the next 5 years. So that gives you, as the owner, more flexibility. So when I say the Solo K is a better plan than the SEP, it's better for high contributions, right? It has the employee deferral and the employer. It has a catch-up. SEP IRA has no catch-up if you're 50 years old. The max you could put in is 61, whereas in a Solo K, it's 67,500 if you are over 50. Solo K has a loan feature, lets you borrow 50,000 or 50% of your account value, whatever's less. Solo K has a Roth component. SEP IRA does not. All contributions must be pre-tax. So the Solo K also has an exemption for UBIT, for unrelated business income tax, if you are into real estate investing and using a loan to buy real estate, whereas an IRA does not have that exemption for the UBIT tax. So all in all, the solo K is a far superior plan than the SEP. But these are the only two reasons, if you're self-employed, I would say do the SEP. One is you make $1 million and you're going to max out and you're under 50 and you don't care about Roth or a loan. Then you're going to be able to put in 61 each way. 20% of $1 million is 200 grand and you can't go above 61. So you're going to satisfy the max. But once you're over 50, the solo would give you that $6,500 catch up. Or if you needed a loan, for example. Or the second is if you have a new business and you have some employees, the 3 out of the 5 year rule allows you to do SEP contributions for the next 3 years without having to offer your employees that percentage benefit, right? So let's say it's you and 2 other employees, you have a startup, everyone makes 100K. Well, and you want to do 25% because you're all W2. Well, $25,000 times 3, $75,000, right? Everyone makes $100,000, 25% times 100, 25K times 3, 75K. It's a lot of cash. Whereas you can be like, hey, yeah, maybe it's not the coolest thing to do, but I care about myself. So I'm going to do 25 for me. And since you haven't worked here you haven't worked here for 3 of the next 5 years, 3 of the last 5 years, I don't have to offer you that 25K benefit until you are here at least for a year. So you have some flexibility if you want to take care of yourself and not necessarily share the love with your employees. So that's the SEP IRA. Just think of it as it's profit sharing. It's really just an employer contribution plan. The word profit sharing is there just because generally companies don't do employer contributions if they have no money, they have no profit. But we've seen it with startups. Yeah, right. You can be a startup, raise $50 million and lose $10 million and still need to take care of your employees. So you're going to still do employer contributions, even though technically you have no profit. The money's just going to come out of the bank account. Now, a simple IRA, think of it more as a poor man's 401k, poor lady's 401k. Why? Because it's not a profit sharing, it's dollar for dollar contributions, but the dollars are less. For 2022, you can make employee deferrals of $20,500 or $27,000, and that's going to go up to from $20,500 to $22,000. Well, in 2023, it's going to go up to $22,500 or $30,000 if you're over 50. Whereas the simple is just $14,000 with a $3,000 catch up. And for next year, for 23, it's going to be $15,500 plus a $3,500 catch up. So you can put away less money. So why would you do it? Well, there's a reason. Most people don't do simples because you can put away less than a 401k. We'll talk about some of the advantages in a minute. But generally, business owners that set up retirement plans want to be able to put away the most amount of money for themselves. And a 401k will let you put away more than a simple. It's just the bottom line, right? Under 50, 20,500 versus 14,000, and a catch up of 6,500 in a 401k versus 3,500 in a simple. So, the numbers aren't even close. What are the advantages of the simple? Well, the advantage of a SEP or a simple over a 401k is that SEPs and simples are IRAs, meaning the IRA custodian, Schwab or IRA Financial, has to file the documentation regarding the annual reporting of that retirement account. In the IRA world, it's 5498, which tells the IRS the value of the retirement account. In the 401k world, it's a 5500, whether it's an easy or a short form. A 5500 is more complicated, and you, as the trustee or plan administrator of the 401k, have to do. Whereas in a SEP IRA and a simple IRA, the IRA custodian does it for you. Okay, so you have a less of an administrative burden with a SEP IRA or a simple IRA than you would have in a 401k, where the burden falls on you as the business owner, generally as the administrator and trustee. There's also costs involved, right? There's the cost of having a third-party administrator keep the documents in good standing and also file the 5500, which you have to estimate it's going to cost you $1,500 a year. Okay, so there is a cost that you generally will not incur with a SEP or a simple IRA. So that's the advantage of the SEP or the simple. The disadvantages are you can put away less money in both the SEP and the simple to the solo K, and if to a regular 401k generally as well. The other disadvantage, if you have a 401k, you can use leverage to buy real estate. No UBIT tax potentially. There's Roth options in a 401k. There's a loan feature, whereas the SEP and simple do not. A couple other 4 key rules with the simple IRA. There's a 2-year rule, meaning if you set up a simple IRA, you can't roll the money out of the simple IRA for 2 years. Don't ask me why. That 2-year rule does not apply to SEPs, only to simples. You also could not have a SEP IRA or a simple IRA in the same year you have a 401k. Okay, so there's kind of an exclusive plan rule there. One other interesting minor benefit to a simple IRA than a 401k is that in a 401k, most 401ks are known as safe harbor plans, meaning there's like a 3% match. And so long as you do a 3% match of your employee's salary, then the executives or the highly compensated employees could max out and do the full 20,500 or 27,000, right? Safe harbor means, hey, we're going to let the highly comps, the executives max out because they're doing enough to help the rank and file employees. Well, a simple IRA, instead of having a 3% non-elective or a 3% match, they also can allow you to do a 2% non-elective. So you can say, you know what? Instead of doing 3% for anyone that contributes 3%, we'll match 3%. We'll just give everyone a flat 2%. So if I have 10 employees that make 50K, I can just do 2% to everyone, $1,000 versus 3% matching for a 401k or even a simple elective match. So there's some potential playing around you can do to minimize contributions to employees, but it's not popular. Simple IRAs are just not very popular. Okay. Same with SEPs, since the solo K has taken over from the SEP. The only people I see doing SEP are people under 50 that are maxing out, or people who want to take advantage of the 3 or the 5-year rule. I don't see really anyone doing simples. We have 25,000 accounts. I say less than 1% are simples. Really, no one does them. The other advantage of the simple is your employees have more investment options, because when you set up a simple, each participant could have their own sub account and control it, meaning you can let your employees do cryptos or alternative assets without having the fiduciary burden on your shoulders. Whereas in a 401k, as the trustee of the plan, you have an overall fiduciary responsibility with respect to your employees' investment decisions. Simple as you can kind of bifurcate that risk. But as an employer, you can only put away, less, right? The 15,523 or 14,000 this year, versus 20,500, and the catch-ups 3,000 this year versus 6,500 in a solo. So just to recap, if you are a business owner with employees and you don't want to max out a lot, well, then you just maybe don't want to have a 401k, right? Because everyone can just do IRAs and put in $6,000 or $7,000. But if you want to have some type of retirement plan, then technically you can do a simple IRA. You won't be able to put in the full 20,500 or 27,000, but your employees could have more control over their investments, and you can potentially do this 2% non-elective instead of having maybe to do a 3% match. So maybe save a little bit of money, 1% on the match on your employee's salaries, not significant. So putting it all together, that's why the 401k trumps the simple every time. And from a SEP and solo, it doesn't even compare. Now, if you have a 401k, let me rephrase. If you have a small business, okay, let's say under 10 employees, your 3 choices are generally a SEP IRA, a simple IRA, or a regular 401k, or just nothing, and telling all your employees, just here's some bonus money, go make an IRA contribution on your own. The SEP, the 3 or the 5-year rule could be interesting, but if you don't satisfy that rule, then the profit sharing is going to be pretty significant, and it's probably going to persuade you not to do it or dissuade you. The simple could be an option, but you're only going to be able to put in the 14 or 15,500 this year, plus a small catch up of 3,500 next year, versus a much higher contribution max for a 401k. It's a 2-year lockup period. You can't get out of the plan for 2 years, but each employee has their own potential sub account, which gives your employees more flexibility. Or you can do a 401k. And generally, it's a safe harbor where you can do, let's say, a 3% match, irrespective, like non-elective, everyone gets 3%. Or you can structure it where you only do the 3% if your employees put in the 3%. So there is some flexibility with 401ks, coupled with the fact that the highly compensated employees, the executives, can put away more money. That's why the 401k is much more popular than the simple. Add the loan feature, add Roth options, add potential exemption from UBIT tax. Not even close. And that's why the 401k is above the simple IRA quite convincingly. So I hope I've done a good job explaining the SEP and the simple. You've probably seen tons of my podcasts or videos on the solo K. I wrote 2 books on the solo K. It's clearly a way better plan than the SEP or the simple IRA if you're self-employed. If you're not self-employed and you got a business with 1 to plus non-owner employees, it's the SEP, simple, or the 401k. And you're going to see the 401k win out more often than not, unless you can take advantage of the 3 of the 5-year rule, or as a business owner, you don't really care to max out and you're fine having your employees be able to put in less because you don't want to deal with the administration, and you rather an IRA custodian deal with filing 5498s and 1099Rs for distributions, and you don't want to deal with loans or Roths, and you just really want to focus on your business, then the simple could make sense. Again, people do it. It's just 401ks are way more popular because the contribution limits are way higher, and add the Roth component, the loan option, and that's kind of the way it works. But simples do work in some cases, and the 3 of the 5-year rule for the SEP has come in handy for a number of small business owners. So there you go. That's hopefully a very detailed but simple recap of the SEP and the simple if you're a small business owner. And I will do a podcast on the 401k. Maybe I'll do it next week. So this way you can stay with the flow and check the podcast out next week, keep you teased a little bit so you can learn more about 401k plans and the different options you can have as a small business owner. So thanks again for spending some time with me today on AdBits. Hope you appreciate it. Just a bit of information on the SEP and the simple IRA. Thanks for subscribing if you are, appreciate it. If not, you definitely need to. And otherwise, have an amazing day, and thanks for joining. Take care.